Hey, welcome to Patterns and Profits. I'm Tom Gentile, resident pattern trader. If you've ever felt trapped by the emotional roller coaster of news, opinions, and meme-driven hype, well, you're not alone. Here, we focus on patterns, not panic, on profits, not predictions, and based on a proven, repeatable approach that cuts through the noise and helps you trade with confidence. If you want my videos, education, and special reports the moment they're hot off the press, well, then sign up for my newsletter. It's absolutely free. Welcome aboard, and let's get started. Hey traders, Tom Gentile here. Welcome to Patterns and Profits. It's May 11th already, 2026. If you don't know me, I'm America's #1 pattern trader, trying to help you make sense of the craziness going on here in these markets through repeatable pattern trading. Hey, help me out 3 ways here, folks. Number 1, comment throughout this live stream. Love to know what you're thinking about when I go through Money Calendar Monday, when I go through Sell in May, and when I go through cheap and expensive options, which is what I'm doing today. Also, like and subscribe if you find this helpful. And finally, share the channel with other pattern traders, and one more thing I gotta mention this is that this is not investment advice and that past performance is not indicative of future results. All right. Hey, glad to see you guys all hanging out here. Let's go ahead and get started with Money Calendar Monday. And what do I have going on Money Calendar Monday? Well, we are May 11th and Friday is May 15th. And that is Expiration Friday. All right. So, I mean, let's face it, every day practically is expiration day for something. But I'm an old school guy and I like the 3rd Friday of the month. The reason I like the 3rd Friday of the month is that you have the most liquidity. All right. When you're looking at stock options, we're looking at ETFs, options on practically anything out there. The 3rd Friday of the month offers the best, in my opinion, the best bid-ask spreads. All right, the most volume, the most liquidity. And for those of you, and I'm just throwing this out here, that were with me a couple months ago on Cash Flow Mastery, we got some trades closing up this week. All right, we did a little session. It was a closed session for members, and we gave out 5 trades during our Cash Flow Mastery program. Well, 4 of them are closing up this week. All right, and they're all closing up. All 4 of them look like they're going to close up for maximum profit potential. 2 of them are in SMCI. There's a SoFi trade there, Rocket Mortgage trade. And then we got a USO trade all the way down there at the bottom, which looks like it's going out to July, but we might end up closing that one out early. So we went 5 for 5. I'm going to talk about patterns, and those of you that are new, how you can join in the pattern trading revolution, okay? And really a great introductory price for those of you that are brand new with us. I'll get to that here a little bit later in the program, but wanted to share that with you right off the bat. Here's what seasonality looks like going through May 11th through May 15th. Again, right across the barrel there, bullishness. All right, we come into today looking at ETFs, and there are, gosh, do you know there's over 3,000 ETFs now? When you look at all the ETFs that are out there in existence, I don't look at 3,000 ETFs, folks. Most of them are garbage, right? I probably look at a couple of dozen at the most, and most of them are now swinging to the bull side and really have been for about a little bit more than a month now. So we have roughly 84% of the list that I am looking at that has patterns. And what I'm talking about are patterns that, and again, there's no guarantee these patterns will continue to work because nothing's 100%. But the patterns I look at are based on seasonality. So I need, 5, 7, 10, 20 years of data going back to help me determine, at least on a seasonal aspect, where these patterns, where I'm projecting them to go. 84% of them right now, looking at 10 years back, have had bullishness starting today. As we go to the end of the week, that number climbs to 87%. So, it begs to really answer the question, and I'm going to a little bit later on in the program, is what's going on with the month of May, right? Those of you And here's a great one I want to start off with for those of you that are coming in. I'm going to hopefully ask this question again, is that how many of you are new to the channel? How many of you are new to pattern trading and new to me? I say that because there is a pattern that we're going to be talking about here a little bit later in the program called sell in May and go away, right? And what I don't want you to do if you're brand new is I don't want you to hear those words sell in May and go away and then leave the channel right now, because you're going to miss a lot. And you got to know a couple of things. If you're going to sell something, make sure you're selling the right thing. But sell in May and go away, we're going to debunk that, all right, here in a few minutes. And I want to talk about why I believe it's buy in May and make money today instead of sell in May and go away. And of course, I've got something for those of you that are option traders before we're finished too. But let's get back to the subject at hand, and that is seasonality. So we see a lot of bullishness going on in the month of May, June, and July. I'm going to talk about not just the month of May, but this week in general. And so when we look at the ETFs look fairly bullish. The ETFs that are coming up on my screen this week, one of them's been coming up for the last 6 weeks, and it's been doing rather well, and that is SPY, the S&P 500 depository receipt. That's the ETF that trades with the S&P 500. We've got some great patterns that have been happening with it. If you're looking at the SPY today going forward, right, over the last 10 years, between now and the end of July, the S&P 500 has moved higher over the last 10 years, an average of 6.27%. Perfect. I mean, this sets the stage, and it tells me, do I want to trade the haystack or do I want to go for the needles? If you want to trade the haystack is the S&P 500. The needles are the stocks in the S&P 500, and the needles are what I look at to accelerate the gains that you see right here. IWM is also on this screen. Several different patterns that we see going on. Also, this one in the last 10 years has moved higher between now and the end of July. If you look at the past 10 years, every year in the past 10 years, we've seen a Russell 2000 IWM that is higher in the end of July than it is right now. Go back and check. Don't take my word for it. And then finally, XLY. All right, what is XLY? If you see it at the bottom of the screen, you can see that it has nearly a 7% average return in the last 10 years. And oh, guess what? XLY also has moved higher and has been higher at the end of July than it is right now in 10 of the last 10 years. Of these three, I want to spotlight one of them. Now, we've been spotlighting SPY for some time now. And IWM, you know, that's a little volatile ETF there to begin with. But the one I want to focus on today is the one that has the most average return in its given time frame, and also because it's different. Something we don't talk about a whole lot here at Patterns and Profits, and that is XLY. So what is XLY? What does it consist of? And what are we looking at? That's what I want to cover here for the next few minutes. XLY. So looking at the spotlight on this is the consumer discretionary sector spider fund, XLY. It tracks the consumer discretionary sector of the S&P 500. So think of the S&P 500 and think of a small pie of the S&P 500, and that small pie is XLY. So what are the holdings in XLY? Retail, e-commerce, restaurants, automobiles, names like Amazon, Tesla, McDonald's. These are typical holdings of XLY. Now, XLY often performs well when the economy is expanding. When you see tech going up, all right, when you see oil going up, that's one thing. But, you know, if you take a look at the price of oil going up, that necessarily isn't good for the economy. Reason being is gas prices are higher. So someone, you know, has a monthly budget, they've got to rearrange the budget if they look at gas prices from last year to gas prices of this year. I was looking at diesel. Last year was $3.50 a gallon. Now it's $5.53 or 50 cents a gallon. That's considerably more. And so someone that was doing a budget and they ran through a couple tankfuls of gas a month may have to pull back in some area to make sure the tank is full so they can get to work on time every day, every week. But XLY, when you see XLY performing well, it's telling you that that trickle down to the economy is performing well, and the economy is delivering. The economy is delivering in the retail front. They are buying things. They are going out and eating at restaurants. They are buying big purchases. They are buying small purchases. And that's what XLY tells us. And for the last 10 years, it's done very, very well during the summer months, spring and summer months. This is the seasonality that XLY is showing us when we look on a year-by-year basis. So if you look here at 2016, right, between now and the end of July, XLY had a 2.26% return. Now, I'm not going to go through every one of these, but I want to spotlight a few. The worst returns were in 2017 when it garnished almost 1%. The best returns, 2020, there was a lot of things. I mean, look at what happened to the consumer as we got out of COVID and they were all cramped up and started the buying binge. And it really exploded in e-commerce, all right? That helped for the 15.91% return during the May, June, July area of 2020. Look at 2023. What was significant about 2023? I mentioned this last week. I'll say it again. We were coming out of a bear market the year before, and 2023 was an acceleration year, 16.59% for XLY. But in every one of these years, you see that it moved higher during this time frame. Here's what the chart looks like when you look at it on a long-term view. This is a weekly chart that goes back to 2022. And you can see XLY. And XLY is one of those followers, okay? It doesn't lead the pack. It follows the pack. So we saw this bottoming happening right at the beginning of 2023. And then all of a sudden, now you see this series of higher lows and higher highs, higher lows, higher highs, all the way up to 120. All right, this was in 2024 and getting to the end of 2024. This was right after the election, before President Trump was even put in office. Since then, we saw a pullback to 90. We've seen a rally back above 120, and here we are. We're touching 120 on the XLY weekly chart, and we've been touching that since the end of 2024. So is this going to be the year, or more importantly, the summer, that XLY gets a breakthrough? When you look at the sentiment out there in the market right now, the sentiment is that the Middle East is going to drag the markets down. The sentiment is the price of oil is going to drag the markets down. The sentiment is everywhere you look, somebody on mainstream media is telling you why you should move aside. And I'm not here to tell you to buy or sell or go long or go short. What I'm here to tell you is that I follow patterns. And patterns that I do not follow, because they're not patterns, are memes, meme-driven, Main Street-driven, day trade-driven. Again, I'm not a day trader. I'm not a meme trader. I'm a pattern trader, and I follow patterns. And the pattern we're seeing here is a pattern that happens around this time, and it has happened around this time every single year for the past 10 years. So when you kind of add it all up, all right, XLY is the tail wagging the dog. And as the markets continue higher into May, we start to see that transition where we move into some of the more consumer-related stocks. Now, keep in mind also is that we're starting to see retail stocks delivering earnings reports. And for the most part, those are good. This is going to continue to make that XLY and the stocks trading within XLY continue to move higher. Consumer discretionary stocks usually follow the pack, and ETFs like XLY will tell us the story of the economy. Now, I want to mention one more thing. For those of you that are brand new with me and you're thinking, Tom, how can I get started trading patterns? All right. Here's a great way you can do it for less than $1 a week. And the way you do it for less than $1 a week is that you subscribe to my Stock Cycles Trader. All right. I do up to 5 stock patterns each week. We have a 7-part rules trading course that comes along with this on how to trade seasonality. There's a members only website this comes with, a library of special reports, monthly strategy sessions we do, and a free subscription to Patterns of Profits. This is regularly much higher. We've got this right now at $49, but you got to do 2 things. Number one, do you see that QR code above me? Right? That QR code above me, and I'm going to flash the $49 one up there right now. Take a snapshot of that QR code. That's the first thing you want to do. And when you go in, make sure you type in, it says it down there at the bottom. I put my red arrow right next to it, SCT49. Because if you don't type in SCT49, you will not get the $49 promo price. All right. So there it is. My top stock patterns for less than $1 a week. I'm going to leave that QR code on the screen, but make sure you don't walk away without that promo code, SCT49. All right. Let's talk about a new pattern. A new pattern. It's not so much a new pattern, but when you look at the totality of seasonals going into May, going into June, going into July, a lot has changed when you look at, especially in my lifetime. A lot has changed in my lifetime to where is sell in May becoming buy in May. Let's take a look at the data and let the data speak for itself. So sell in May or buy in May. There are 3 pillars, right? It's actually 5 pillars I'm looking at, but I want to share the first 3 with you. I'll talk about the other 2 as we get to the end of this. But the first 3 pillars are, I want to talk about first the anatomy of trading transformation. All right. Trading transformation, meaning my trading transformation. Then I want to talk about the statistical decay of sell in May. And then finally, geopolitical shocks and how they all incorporate into something like this going forward. So the old adage, before I get into sell in May, I had an old adage too. My old adage was when I was a teenager and I first started trading in 1986, I didn't have any knowledge, didn't have any plan. You know what I did? I watched mainstream media and I created the perfect storm. Now, this didn't happen in one day. It was several months because what I did was watch mainstream media. And the worst thing that could happen to me as a trader just getting started is I was right. You might say, how can you be right, Tom, and feel like that's the worst thing that could happen to you? Because I thought this was too easy. All I got to do is watch FNN. That's what it was called. That's what CNBC was called back in the day. It's called FNN. So I'm watching FNN, and I see a guy on there screaming his bloody head off. Now, this is after I'd accumulated some money trading. I thought, this is great. I'm going to quit my job. I can do this full time. Why isn't everybody doing this? It must be because everybody doesn't know how easy this is. This is me. This is me at 21 years old. No knowledge, no plan. And eventually that means no money, because on what was it? Black Monday, October 19th, 1987. So I went from 1986 to 1987 doing well. And in 1987, one day, it was all taken away from me and then some, because I took my no knowledge. I didn't learn anything. I felt I didn't need to know anything. You know what I thought? I thought that the stock market was easy. Why isn't everybody doing this? All I got to do is just watch TV, and whatever they're talking about, I'm going to do. Options were cheaper than stocks. That was the only thing. Options were better because they were just a stock, but cheaper. I mean, every novice trick in the book, I was already learning at 21 years old. Guys, this was almost 40 years ago for me. In fact, it's coming up on 40 years here for me, as I'm going to turn 61 next month. I can't believe the time has gone by that fast. But for those of you new, I'm sharing some nuggets with you here. So think about this. Eventually, if you come at this with no knowledge and some greed, all right, and you follow the gurus that have no skin in the game, which is what I was doing back then. I was following people that had no skin in the game, screaming their heads off about buying this or buying that. And eventually Black Monday caught me, and I ended up getting into a margin call, which means I was wiped out. Not only was I wiped out, I was wiped down where I owed my broker money. And it took me a year to come up with the money to pay back because I was only 21 at the time. So I decided to stick around and figure out how to do this correctly. It took years for me to do it, right? Because I didn't have a mentor. I didn't have a mentor until the early 90s. And then things came a bit quicker for me. But I want to share kind of then there's versus now. So then what was I doing? I was trading subjectively, right? I was trading on feeling the news anchors and, just not verifying things. It's a recipe for ruin. The solution that I found, and I didn't even know what the solution, I had the solution, I didn't know what it was. Rules-based trading, right? Back testing, getting a theory, turning that theory into a pattern, back testing that pattern, making sure the pattern actually works, then taking that pattern and putting it to work in the market. And, you take a look at, I'm going to take you to now. S&P's was down coming in the beginning of May, was down 4.3%. Retail crowd was panicking, much like I did when I was a kid. As a pattern trader, I didn't see a crash. I saw an opportunity. I saw data-driven entry points. And that's what I want to talk about here. So you take a look at the long term. This is where sell in May has become buy in May. The chart you see on the screen right now as I blow it up, this is when sell in May actually worked. Prior to 2010, sell in May, we saw drops in the markets. There were some areas where the drops in the markets, the post-Korean War, the Kennedy slide, Nixon recession, oil crisis, Iran oil crisis. There's Black Monday, Gulf War, dot-com bubble. All of these had Mays, where between May and November, those 6 months, the market spiked in volatility, and we saw a drawdown in the S&P 500. But look what's happened since 2010. What's happened in 2010 is the pattern has flipped to bullishness, where we're seeing more money printing happening around this time. We're seeing there were things like credit down slides. There were things like U.S.-China trade that was going on in 2010. We saw COVID in 2010, but that didn't disrupt the new change with what's happening in May, June, July, all the way up into November. But really that May, that buy in May or that sell in May and go away has become buy in May and make money today. And looking at that May, June, July area, all right, in between that area where we see Q2 and we see from the end of Q2 and the start of Q3, that pattern is now flipped over and become bullish. Take a look at last year. Last year, I had this same discussion. Some of you were here. Who was here last year listening to me when I said, it's not sell in May, it's buy in May and make money today, right? The video's still out there. If you want to go take a look at it, it's still there. Absolutely the worst time to sell in May last year because we had that April bottom that happened. We came back and we actually ended higher. We ended slightly higher in April. We're really close to the same at the end of April than where we were at the beginning of April, and May was just a continuation. S&P jumped 7.5% from May to November of 2025, posted new all-time highs. So you take a look at that. Sell in May and go away would have been the worst thing to do because, if you look at the historical baselines, we saw, that disparity during 1950 to 2010, 1.8%. Okay. I mean, volume left the building back then. But between 2011, 2021, and then I started looking at 2, 3, 4, 5, 4.4% during those time frames. Last year, we saw 7.5%. So this just further shows that there's been a change in the weather and a change in the pattern when it comes to the months of May, June, and July, right? Here is my case study. There's the thumbnail to the actual video I did. Buy in May and make money today. May 1st, 2025, S&P was at 6,500. October 31st, 6,900, 7 to 7.5% gain in 6 months from May to November. This is a warning to those of you that are selling May and go away fans, because it has not worked very well for the last decade. Okay. Pillar number 3. Now we got to add something else to this, because this is the whatabouts. Okay. Tom, what about interest rates? Tom, what about the hantavirus? Tom, what about Iran? Tom, what about Lebanon? Okay. These are what are called geopolitical shocks. And when we talk about things like viruses, those could be, you could call that a geopolitical shock too. That could be debatable. But you take a look at the for 2026, the biggest thing that's happened is Operation Epic Fury. That was launched in February 28th. Oil spiked to $100 a barrel. S&P pulled back. But again, that didn't happen in May. It happened in February. The market digested that. And now the market is looking to digest lower oil prices. If we do see now, take a look at oil prices, and that could be something that that might be debatable too as well, is that high oil prices are good for America. They're good for certain sectors, but to me, it's also a tax on the consumer. So if oil pulls back into a sweet spot, and I think the sweet spot's somewhere around $65, $75 a barrel, then it's good for everything. It's we get a discount at the gas pump, but then you got oil stocks, you got oil petroleum companies that are making money. And we have something called a 9-month recovery rule that basically, when you take a look at these geopolitical risks, you have these phases. We have the shock phase. That's the first 1 week to 1 month where we see a sharp decline, and we get a lot of uncertainty. We get a lot of news headlines coming out of mainstream media. Phase 2 is the bottom, which is the worst case scenario the market predicts in. And phase 3 is the recovery, which is an average of 17% gains within 6 months of the shock. Where are we right now? Take a look at this. So if the end of February was the shock and the end of March was the bottom, then May, June, July, August, September, October, that's the next 6 months. That's also right in line with the buy in May and make money today rule. So in conclusion, as we move to the summer of 2026, right, the noise is already deafening. Oil prices, Operation Epic Fury, the death of the bull market. The data, however, is clear. The data says sell in May just ain't making money today. The best thing to do is buy in May, and we're now the era. And I believe that era, even though we're now 10 years in, we've got 10 years of data. I think that's just beginning. And the big takeaway that I have for you here, when we take a look at all this, is very simple. All right. The simple takeaway is this. Don't be a day trader. All right. Don't be a meme trader, but be a rules-based pattern trader. And there's no guarantee that the rules that I put forth to you today are going to continue to work. But me, you know what? I get out of bed the same side of the bed every morning. I put my shoes on the same way. I have patterns in my life, and I believe patterns are the way, or really for me, in my humble opinion, the best way to make money today. Hey, welcome to Patterns and Profits. I'm Tom Gentile, resident pattern trader. If you've ever felt trapped by the emotional roller coaster of news, opinions, and meme-driven hype, well, you're not alone. Here, we focus on patterns, not panic, on profits, not predictions, and based on a proven, repeatable approach that cuts through the noise and helps you trade with confidence. If you want my videos, education, and special reports the moment they're hot off the press, well, then sign up for my newsletter. It's absolutely free. Welcome aboard, and let's get started. All right, here we go. I had to take a little sip of coffee there, but I'm back, guys. And as we round out our session of Patterns and Profits here, if you're just joining me and you're brand new to patterns, I've got a way you can follow me with my top stock patterns for less than $1 a week. This is something I call Stock Cycles Trader. right? With Stock Cycle Traders, we do up to 90% stock patterns every single week. We do it comes with a 7-part rules-based trading course. There's also access to the members-only website, a library of special reports, monthly strategy sessions, free subscription to Patterns and Profits, and it's $49 today if you want to take advantage of it. I'm actually going to put it in the description right now, just in case those of you are actually using what you use right now to look at that QR code that I put up on the board. And you know what? I'm going to put that QR code. It disappeared. I'm putting it right back up there now so you can have a look at it as well. Make sure that if you want the $49 price, you want to use the promo code SCT49. SCT49. That'll get you that $49 price for an annual subscription of Stock Cycles Trader. All right. So those of you that are option traders, you're going to absolutely love this. So we're working on something, and it's going to be available really soon, but I thought I'd spill the beans and show you something that we are bringing back to the community by popular demand. And that is taking a look at options, all right, whether options are cheap or expensive. So, there's a lot of different ways that traders out there look at pricing options and determining whether an option is cheap or an option is expensive. I'm going to show you the 3 most popular ways. 2 of them I would touch with a 10-foot pole. All right. The absolute worst way to price an option is just simply by looking at its option price. There's the wrong way, which is using implied volatility, but not the way I use it. And the right way, which is using the ranges. I'm also going to show you today's cheap and expensive options as well. So let's talk about these wrong ways first. Wrong way number 1 is options by static price. So there's traders, and these are novice traders that come out, all right? So not everybody does this. But someone will look at a price of Amazon or look at a price of an Apple option. And then they'll weigh it to a price of like Rocket Mortgage or Snap, one of these cheap dollar stocks. And they'll say the options are cheaper on Snap than they are on Amazon. And if we're talking about actual price for an at-the-money call or an at-the-money put, then you're right. But what a lot of newbie option traders don't realize is that cheap options price is based on that cheap stock, and that expensive option price is based on that expensive stock. So you get what you pay for when you're looking at static price. But you can't tell just by looking at static price only whether the option on that stock is cheap or expensive. Now, at some point during an option trader's time, they start to understand time. They start to understand implied volatility. And they understand that implied volatility is the time premium built into an option. And so they might look at IV, and they see some IVs that are at 20, and they might see an IV that's at 200. And they go, oh, the 20 is cheap and the 200 is expensive. But I'm here to tell you that's not the case, because you can't base implied volatility on it only on price. Because if you did, then you know what you're going to look at? You're going to be saying, oh, well, all these quiet stocks have a cheap rating and all these explosive stocks have an expensive rating. And again, that's not the right way to do it. You're not much better off than looking at price only. So factoring implied volatility means more than just looking at the current number and saying that's expensive or that's cheap. Because how do you know? How do you know that a 200 IV is expensive? Well, 200 IV would be expensive, but how would you know if a 50 IV is expensive or cheap? Unless you have data going back over time that shows that 50 was the highest that those options traded on that stock in a given time period. So I say, don't look at price, all right, only. Don't look at IV only, but look at IV over time. And so what we do is we measure IV by range. So we take the implied volatility, all right? The implied volatility is a number that you can get this practically anywhere now, all right? If you have Robinhood, you can look at the IV of your options on Robinhood. But what we do is we timestamp that IV every single day, and we have years of that. So I take a year of implied volatility rankings, because in a year, what do we have? We have a lot of price data. We have a lot of fundamental data. we have at least 4 earnings cycles in a year, right? 4 earnings cycles. And during that 4 earnings cycles, you could see the options on these stocks, and the stocks too, getting volatile and getting quiet. So you're actually creating a band of low IV and a band of high IV, and you can measure the lows and highs and then where that stock is right now. So we get the 52-week low, we get the 52-week high, and we get the current IV where it currently is. Cheap options would be near the 52-week low rating. Expensive options would be near the 52-week high rating. And that's the way that I look at implied volatility. Here's an example. This right now is one of the cheapest options out there. It's the Ethereum Trust, ETHA. 1-year chart. If you take a look at price and vol, the price is the candlesticks you see here in red and green. This is the implied volatility. This implied volatility is the 30-day option. Notice where it's been. IV numbers on the left, all right? Price of ETHA on the right. IV, it stayed pretty static here during the months of last month from June to December. Then it dropped to lows in 2026, and then it spiked up because look what ETHA did. It dropped down to new lows. These were new lows that we hadn't seen in some time, and then it consolidated. Those new lows, there was some panic selling going on. Implied volatility jumped, and it jumped from the 60s, right? From the 60s and 70s all the way up to 115 or 1.15 before coming right back down. It came down really fast because we found a floor, all right, on the price of Ethereum. Now, Ethereum's kind of slowly moved up a little bit, and so has ETHA. But look what the options volatility's done. It's come down to new lows. So February option prices on Ether were cheap, right, or expensive. Now they're cheap, but look where they are relative to the year. They're as cheap as they've been in the entire year. That's why I say that ETHA, options on ETHA are cheap compared to where they've been. In fact, these are the top 5 that we are taking off of the Hub platform right now. ETHA is number 1, TMF, all right? That's a treasury bond ETF. Number 2, SEZL, all right? Sezzle comes in at number 3, Ascend, pharmaceutical, number 4, and Pitney Bowes rounds out the top 5. The areas I want to show you is this is the IV for today. Look where the IV range low is for the year. They're all the same number. These 5 have made new volatility lows recently. Right? Now, let's take a look at the other side. What's expensive right now? So expensive would be where we see vols trading near the 1-year highs. Micron Tech has got a 1-year high happening right now. So if you, again, you can see the price of Micron has gone from somewhere down there near 100 to near $800 a share recently before pulling back a bit. Well, volatility was down here in the 40s. It's now to buy an at-the-money option between sometime last year and this year, you're paying twice the price. You're paying twice the time premium now to hold the same that at-the-money option. And I'm not saying, oh, it's more expensive because the stock's expensive. That's a given. But the implied volatility is more expensive as well. You can see the lows and the highs that have happened. All right. Lows and highs, lows and highs. These kind of come around earnings, and we got some earnings coming up for Micron. But notice what the IVs have done because the stock has gotten expensive, and there's a lot more volatility surrounding where the future of Micron is going to be. That's pushing option prices up to 1-year highs. So this is one. Again, what's the denominator? Where is the low been in implied volatility in the last year? Where's the high been in implied volatility in the last year? And where is it at right now? All right, rounding out the top 5, you got Micron Tech here as an expensive option. Intel is also expensive. That's not surprising. I mean, Intel is what, doubled in the last month or two? It's up from the 20s in the last year. Qualcomm, number 3. Tower Semiconductor, number 4. And Cisco Systems, number 5. It seems like all the semiconductors, 4 of the 5 are semiconductors. And you've got Cisco, which is telecommunications, all sitting on their high. Look at their IVs, current IVs. Look at their high IVs. All sitting on high options implied volatility. So that is what I wanted to share with you today. So as we wrap up, We had a Money Calendar Monday looking at XLY. All right. I did a deep dive on sell in May and go away or buy in May and make money today. And finally, I wanted to share with you something that we're bringing back. And this will be available on the Hub platform in the not too distant future. We're just tweaking a little bit on the beta site, but this will be a screener. It's going to be available on the Hub platform where you can screen the cheap and expensive options on stocks the same way that I do it. All right. Guys, thanks for joining me. Have a great rest of your day. I'll see you again here same time next week. Bye, everyone.